Thank you for watching this video from the Canada-Europe Transatlantic Dialogue at Carleton University. This event is sponsored by the Canada-Europe Transatlantic Dialogue, CETD, and the Faculty of Public Affairs Research Month at Carleton University. CETD receives funding from the Social Sciences and Humanities Research Council of Canada. The views expressed in this video are solely those of the presenter and do not reflect the views of the CETD, SHRC, or Carleton University.
We have three excellent speakers today, and I will introduce them in the kind of order how they speak. The first one is Tatjana Muravska. You start. Also, in the way we try to set up in terms of content, how to approach the whole problem. And Tatjana will speak from a, let us say, a perspective of the EU member states of the European Union. Some of them who aren't yet part of the Eurozone, some of them are part of the Eurozone. So how do they think about the euro as a common currency, the advantages, disadvantages, benefits, net costs? So this will be the first speaker. Tatjana is a ad personam Jean Monnet chair. So the most prominent kind of, there are many here in the audience actually, as it turned out, but still, she's one of the few, and we have all of them here in Ottawa, so that's a good thing, at the University of Latvia. This will be followed by George Ross on the right side from her. George also is in that persona, Jean Monnet chair at the Université Montréal. George is, so to say, our old hand. You know, I wouldn't know many people who have seen so many crises of the European project than him, coming, going. So, and he always is observing them and making excellent analysis about those processes. So I'm very much looking forward to hear from him. And then we have Patrick Leblond, a kind of local, this University of Ottawa. After reading his paper, and even we know each other since a long time, immediately this came up in my mind, young Turk. You know, this is the kind of the young revolutionaries have total different views from mine and are coming forward with strong arguments. And I'm so happy that, no, it's great, you know, because this is what it's all about. We have to have different views on the same topic. Hopefully we have very fruitful discussions. And that's also the reason that I hope so. I don't know, but I don't have the authority. But unlike yesterday, I really tried to make sure that they only talk like 14 minutes each, that we have a lot of time for discussions with you, questions, answers, but also ready to discuss, because this is a topic, I think, so where a lot of things are coming together. There is very fundamental question of economic policy making. We all know about this kind of austerity fever, particularly from the Germans. What does it all mean? And talking about all those kind of things, reforms that are necessary, the kind of, what are the implications? What is Canada showing the Eurozone in terms of regaining stability? There are thousands of questions involved in the topic, and I would love that they would only get in a very provocative way to those questions, giving some of their own views and answers, and then we have time for discussions. So, thanks so much. Without further ado, Tatjana, and I start my machine in 14 minutes.
Well, thank you very, very much for the opportunity to participate in that event. Thank you, John, for all of our fruitful years of collaboration. I remember we started in Berlin, then we continue in Riga, then we were meeting in Brussels, once also in Ottawa at Carleton University, and now I'm here. Thank you very much, and I really appreciate it. As well as my colleagues, they all know that we run this project at the university. I was asked to talk about the new member states in the European dimension, in our European integration, so in these perspectives. I'm not so sure how these new member states, why they are still called as a new member states, because we are for the European Union for a number of years. The title, that's why a little bit different, the newer member states. And I also was put in this session, which is after crisis. I would like to, if there will time allows, to talk about the actions that the European Union is taking to deal with the crisis and to prevent the crisis. But however, let me show the first picture that, of course, it was a debt crisis, and in fact, it led to, or almost led to, the currency crisis. Now, back to the new member states and the Eurozone and their accession. In fact, we are talking about 13 new member states, and some of them are already in the European Union. In fact, 6: Slovenia, Malta, Cyprus, Slovakia, Estonia, Latvia, and Lithuania. And you can see also that we have overall we have 13. Some of them, or most of them, became members in 2004, some in 2007, 2 in fact, and 1 in 2013. So we have, as a result, 6 in the MU or Eurozone. We can say that these are countries with the derogation, and those who are not in the Eurozone, the member states, not that many, but they are very significant. And if you think about these countries, then they are bigger than those who are already in Eurozone. And this is one of my points of discussion. Now, countries that joined the European Union, that had requirements right away, in fact, before, in the round of negotiations, and in their treaties, they all have to accept Maastricht criteria eventually, and they have to become members of the Eurozone. So that says treaties of accession, that member states have to make necessary adjustments and to be in the monetary union. However, for countries that became members of the European Union, the target date was not discussed. And some of the countries that I said as countries of derogation, like, for example, we have them here in red and in blue. Romania said that they will probably join, or they will make a target of 2019. However, the others are still discussing the target and not saying the concrete days. They're saying 2020, 2030, whatever is convenient for these countries in the negotiations with the monetary authorities. Of course, behind we have interests. So we have conditions coming from the European Union, from the ECB, and interests of the member states. So the requirement is to have the exchange rate fixed. The fixed exchange rate, or accepted in the exchange rate mechanism in 2004 with their accession to the European Union, Estonia, Lithuania, and Slovenia. In 2005, Latvia, Malta, and Cyprus, and Slovakia joined this exchange rate mechanism. However, the other countries, they are still not in the exchange rate mechanism. Why? Because it requires dependence on the monetary policy. If you are in the exchange rate mechanism, you cannot accept to run your own monetary policy. So countries should forget about their monetary independence. And in fact, it's happened already with the exchange to the, with the accession to the exchange rate, or acceptance of the exchange rate that was fixed. But the countries, as a result, in their central banks were more busy with the sort of research about monetary issues, but were not able to pursue their own monetary policy and to influence the market situation in their own countries. Not everybody agree with this, and the big countries are still hesitating whether they should do it or not. However, there are a number of benefits that countries consider that if they lose the monetary independence, they still have benefits. We should not forget that all of these new member states, they were going from a common economy to transition economy. They had to, or they experienced shock therapy, and they also had to make the necessary adjustment in their structure and their structural reforms. So very important was institutions and policy framework. And one of the indicators that they are ready for the accession to the European Union and that they are functioning as a developed economies was the real convergence. So in fact, the real GDP per capita levels, which is still below Bulgaria, Romania, still below the average of the European Union. And of course, we cannot compare ourselves, small countries, to, for example, other small countries in the European Union like Luxembourg, but nevertheless, this is a target. And the euro adoption, it leads to the further economic, monetary, and exchange rate policies, development, and the structural reforms and adjustment to the market. So it also helped to direct policymakers, and also it's also directed the markets for the countries and for their benefits. So benefits for the small states, well, I tried to list them, and in fact ended up with a long list of benefits. For example, the new economic EU governance. Well, it happened during the crisis, and of course it's important for the countries because we can expect the economic stability and sustainability. It's not only the European Union governance, not only the EU requirement. In fact, it's very much so the requirement of the international institutions, and on the first place, the International Monetary Fund. But another benefits, besides that this is a real convergence, this is also a geopolitical choice and geopolitical risks. It maybe sounds not very convincing. The monetary union is about the monetary policy, and the geopolitical choice and geopolitical risks, this is about how to have stronger relations with the European Union and not to be touched that much by the big neighbors, like, for example, Russia, that for the small countries was very important. So it's, in a way, the building the wall between these countries and Russia. Then transparent and competitive markets, single euro payment rates beneficial for the business, and cross-border trade was increased, and reduction of risk of losses caused by the global currency fluctuation. So all these benefits, small countries were considered very seriously and made their choice. At the same time, as in my title, I said the monetary maturity. So how can we look at this, for example, trend, if we can may call it like this, monetary maturity? First of all, we have in the European Union quite a rigid framework, as I already mentioned in some of the previous slides in one and another context. But these are the requirements. And for example, 2011, there was a macroeconomic imbalance procedure established in response to the economic and financial crisis, which means that the European Commission and the European Central Bank, they monitor and they correct macroeconomic imbalances in all EU countries, especially for the Eurozone. It's especially for the Eurozone, but anyway, all the countries are corrected. But more stronger policy is towards the Eurozone countries. So not necessarily it's a very pleasant policy for the independent states. Now, macroeconomic imbalance procedure also contains an enforcement mechanism, including the potential use of sanctions. And that is very important. So if you don't cope with the requirements, you can end up with the sanctions. So what is this mechanism? This is a set of indicators, and if we will have time, then I will be very happy to show you some slides how it works in reality. So this mechanism is trying to, or with this mechanism as a tool, the European Commission and the ECB trying to not to allow macroeconomic imbalances, divergence, and competitiveness that should be increased, and divergence should be increased and decreased in the European Union. So what could be the challenges for the non-European Eurozone member states? First of all, it is fluid, their policies, and depends very much on political and economic challenges in the EU and the national levels. For example, this is just one example, the system of votes rotation at the European Central Bank. This happened, the change of the system in 2015, it's just coincide with the Lithuanian accession to the Eurozone. It's nothing to do with Lithuania, but media is putting out a number of questions that it's happened because Lithuania exceeded the Eurozone, and then the number of member states become larger, and playing with this number 19 countries, that's why there is the system of votes rotation. But in a way, it was foreseen long time ago that the ECB will do it, well, independently from the accession of the member states to the European Monetary Union. So which means by this procedure that the bigger countries that are in a better position in terms of voting. And we are discussing the participation in the voting system, which is important for the countries to be involved in the decision-making process. As I mentioned in the previous slides, the divergence of the European Union, this is one of the reasons why countries are not necessarily happy to be members of the European Monetary Union. And there is a very famous now 5 presidents plan that was published, report on this, that was published in 2015. It is about the steps towards completing economic and monetary union. 5 presidents, including the European Commission, European Council, Eurogroup at the European Council, Central Bank, and the European Parliament. So what they discuss in the report, what the main elements that should be needed to be done in order to harmonize Europe, in order to not to have these big differences between the countries in terms of their structure, in terms of their GDP, in terms of their policies, in terms of their labor markets, inequalities, unemployment, social system, human capital formation, etc., etc. So they're taking the human dimension, but also these are the elements that is a fundamental ones for the development of the monetary issue. So the long-term economic success that is planned by the European Union. And about the maybe key consideration for the member states who are still on the road to the Eurozone, we have the group of larger member states. And the problem that I mentioned, let me summarize it, it is heterogeneity and divergence in this European stability mechanism that they contribute but are not always happy. And they would like to Eurozone be attractive for them to join it. Well, at the same time, there is also a sense of European Union functioning in terms of solidarity and participating, for example, in the reinforcement of economic pillars of the European Union and trying together to get Europe more competitive. So in conclusion, I would like to stress that as a result of this, my research on why there is a difference between the member states, that we have, first of all, circumstances when member states can join each other by the non-participating member states in the European Union when there is a need to reinforce the pillars of monetary union. They also are interested, all of them, in minimizing geopolitical risks and to avoid political and economic isolation, but they do it differently. These small, the big member states, the members of Eurozone, non-members of the Eurozone. So that's why they are not on the same, we're on the same boat with the European Union, but not on the same boat in Eurozone. Well, there is also need to reinforce social and labor markets, and Eurozone is attractive to all member states when it is stable. So every member is, well, required, if they are in the club, to contribute to this stability, which is very difficult to reach. Thank you very much.